Bernie Madoff promised steady, safe gains of 10 to 15% a year, and for decades people actually got the statement showing they were getting rich. Then in 2008, more than $18 billion in real money was gone overnight, exposed as the largest Ponzi scheme in history. Bernard L. Madoff didn't look like a con artist. According to an academic overview of the case, he was a well-respected Wall Street insider, a former chairman of the Nasdaq stock market, and the longtime head of his own firm, Bernard L. Madoff Investment Securities, LLC, which he founded back in 1960. Over more than 4 decades, that firm became a major player. One article from International Banker notes that Madoff built significant broker-dealer and proprietary trading businesses, and that his firm was at one point the stock market's biggest market maker. So when Bernie Madoff said he'd figured out a way to generate steady returns, people listened. Pension funds, charities, wealthy families, and regular individual investors all bought into his reputation. The pitch, according to research summaries, was simple: consistent returns in the 10 to 15% range year after year, with sophisticated strategies that sounded complex enough to be impressive and safe enough to be comforting. On paper, it looked like the dream. No wild swings, no scary drawdowns, just smooth, upward-sloping account balances. For decades, investors received elaborate account statements and other documentation that showed their money supposedly sitting in real investments and earning these returns. A NASAA investor education bulletin describes how the investments appeared legitimate, especially to investors who were receiving payments. From the outside, this looked like a genius at work. Inside, Madoff was running what regulators and prosecutors later called the largest Ponzi scheme in financial history. Here's where the story stops being about Wall Street and starts being about psychology. The NASA advisory on Madoff's scheme points out one crucial promise: unrealistically steady returns. Madoff purported to deliver about 10% per year for decades. Not on average over time like a normal market investment, but persistently, almost regardless of what the market did. That constancy is what pulled people in. A 10% return doesn't sound outrageous. You can find years when the stock market does much better. But the key detail, according to regulators' education materials, is that doing this consistently for decades, with low volatility, is unrealistic, if not impossible. To make it all seem real, Madoff's firm generated detailed, fabricated account statements. According to NASAA, these documents convinced clients that their money had been placed into actual investments. Every month, investors saw trades, positions, and profits printed in black and white. And the kicker? Some investors were actually getting paid. People who asked for withdrawals received money, sometimes for years. That visible cash flow made everything feel legitimate. According to the NASA description of the case, this is classic Ponzi structure. Madoff paid returns to earlier investors with money from a steady flow of new investors. There were, as the bulletin puts it, no actual investments and no actual returns. On the surface, it was a miracle machine. Underneath, nothing was being invested at all. Here's the uncomfortable part. This scheme was not invisible. According to an academic summary of the case, there were numerous warnings about Madoff's practices, including several detailed reports sent to the Securities and Exchange Commission by financial investigator Harry Markopolos. He argued that the returns Madoff reported were mathematically impossible and asked regulators to investigate. But those tips, that same summary notes, went largely unchecked for years. Outside the regulators' offices, warning signs were also visible to anyone who knew what to look for. The NASAA Investor Advisory lays out some of the classic Ponzi red flags, and it uses Madoff as a textbook example. First, the returns. Steady, positive performance at around 10%, year in and year out, even when markets were volatile. Any legitimate investment involves risk. Guarantees of high or perfectly consistent returns, especially over decades, are described in the bulletin as a clear warning sign. Second, the too good to be true test. NASA's guidance says that delivering consistent 10% returns for decades is unrealistic, if not impossible. Yet many sophisticated investors were reassured by Madoff's reputation and the social proof of seeing other wealthy people already in the fund. Third, the paperwork itself. The same bulletin explains that Madoff's investors were given elaborate fabricated account statements and other documentation that only mimicked real investments. The documents looked professional, but anyone comparing them closely to independent brokerage records or market prices might have seen inconsistencies. So why did so many people wave it all through? Because the story fit what they wanted. A trusted insider, a smooth return stream, and the comfort of seeing others already on board. Confirmation bias did the rest. The lesson buried in this phase of the story, according to regulators' own post-mortems, is that Ponzi schemes are not too difficult to detect if you know the warning signs. The problem wasn't that Madoff was undetectable. The problem was that the signs were easy to rationalize away. For a Ponzi scheme to survive, one thing has to stay true. More money has to come in than goes out. For years, that worked. New investors kept lining up, and existing investors mostly left their gains on paper. According to an academic article on the case, the scheme involved approximately $64 billion in capital over about 20 years. That figure includes all the fake profits that appeared on client statements. But there was a much smaller number behind that. The actual money that had been put in and then disappeared. Direct losses for victims, that same article notes, exceeded $18 billion. Then came 2008. As the global financial crisis hit, investors everywhere needed cash. According to NASA's case summary, large numbers of Madoff's clients started asking to cash in their investments. At the same time, the downturn made it harder to find new investors. Suddenly, the math broke. The NASA bulletin describes the moment clearly. Madoff did not have enough money to cover his investors' requests, and new investor money was hard to be found in the economic downturn. The steady inflow of fresh cash that had masked the hollow center of the operation slowed to a trickle. On December 11, 2008, the illusion ended. According to an EBSCO research summary, Madoff was arrested that day and charged with 11 felony counts, including securities fraud, wire fraud, money laundering, and perjury. CBS News would later look back and describe those charges as involving a $50 billion Ponzi scheme, the largest in U.S. history. Other sources, including that academic article and international banker, put the scale at around $64 to $65 billion in purported assets, with more than $18 billion in real money lost. Madoff pleaded guilty in March 2009, according to the CBS archive piece. An international banker notes that he was sentenced to 150 years in prison. He died in a federal prison hospital in Butner, North Carolina, while serving that sentence. For investors, there was no miracle recovery. Many charities, families, and funds were left in financial ruin. Years of statements and profits vanished into a black hole the moment the withdrawals overwhelmed the inflows. The world discovered that the man once trusted as a pillar of Wall Street had for decades been paying old investors with new investors' cash and nothing more. So, what do you do with a story like this, besides feel angry on behalf of the people who lost everything? Regulators and investor education groups actually turned the Madoff case into a sort of curriculum, a checklist of what to watch for so you never end up in the same position. The NASA bulletin on Madoff boils the lesson down to a few simple rules. Number 1, be suspicious of consistent above-average returns. Real investments go up and down. Any advisor who suggests they can deliver 10% every year with barely any volatility is either taking massive hidden risks or not telling you the truth. According to NASA, guarantees of unrealistically high returns and delivering consistent 10% returns for decades should be treated as major red flags. Number 2, don't outsource skepticism to reputation. Madoff's status as a former NASDAQ chairman and major market maker lulled people into ignoring obvious warning signs. But the fraud itself, according to regulators' own write-ups, relied on very basic tricks: fake paperwork, new money paying old investors, and a story that sounded good. Number 3, verify independently. NASA's description of Madoff's scheme emphasizes how investors were convinced by elaborate but fabricated account statements. One way to protect yourself is to insist on third-party custody and independent statements directly from a recognized brokerage or bank. When your only window into what's happening is paperwork produced by the same person taking your money, you're vulnerable. And finally, remember that Ponzi schemes are not magical. The NASA advisory argues that even a massive operation like Madoff's is not too difficult to detect if you know the warning signs. The trick is to actually act when you see those signs, instead of explaining them away because the story feels safe. In other words, the core lesson from the largest Ponzi scheme in history is this: if an investment offers you comfort instead of questions, you're the perfect target. The people who stayed safe weren't the ones who could do advanced math. They were the ones willing to walk away from too good to be true. Madoff's victims weren't foolish. They were comforted by a smooth story and a trusted name. The practical takeaway is that any investment claiming steady, above-average returns with little risk should trigger skepticism, independent verification, and, if the answers aren't crystal clear, a hard no. If you want more money autopsies like this, and to learn how to spot the next too-good-to-be-true opportunity in your own life, hit subscribe and tell me in the comments, what's one investment pitch you've walked away from because it sounded a little too perfect?